Is buying options a good strategy in high implied volatility? Have you ever wondered if buying options is a smart move when implied volatility is high? Let's break it down and see what this means for your trading strategy. First, let's understand what implied volatility is. Implied volatility represents the market's expectations for future price movements. When this number is high, it indicates that traders expect significant price swings. This leads to higher option premiums, which are the costs you pay to buy options. When implied volatility is elevated, the price of options increases. This means that if you want to profit from buying options, the underlying stock must move significantly beyond the strike price plus the premium you paid. The higher the premium, the more the stock needs to move for you to break even. This can make it tougher to see profits. Another factor to consider is time decay. Options lose value as they approach their expiration date. This effect is more pronounced when premiums are high. If the anticipated price movement does not happen quickly, you risk losing the premium you paid. There is also the risk of volatility contraction. After a period of high implied volatility, it often reverts to a lower average. If you buy options during this time and the implied volatility decreases, the value of your options can drop even if the stock price stays the same. This can lead to losses. So, what strategies work better in high implied volatility? Many traders prefer to sell options or use credit spreads. Selling options allows you to collect those inflated premiums and benefit from the tendency of implied volatility to decrease. This can give you a statistical edge in your trades. However, there are times when buying options can still be effective. If you expect an even greater increase in volatility or a significant price move in the underlying stock soon after you enter the position, buying options can be profitable. Strategies like long calls, long puts, or straddles can benefit from large price swings during high volatility. But timing is everything. You need to act quickly to overcome the high costs and time decay. In summary, buying options during high implied volatility is generally riskier and more expensive. It is often more favorable to sell options or use strategies that benefit from volatility. However, if you anticipate a sharp price move or a further rise in volatility shortly after entering the trade, buying options can still work. Your timing and market outlook will play a big role in your success with this strategy.